On the surface, the numbers look like a miracle. If you open any financial terminal or look at the latest manufacturing PMI data coming out of Brussels and Berlin, you will see the color green. For the first time in what feels like an eternity, the Eurozone is reporting a PMI of 52.2. In the world of economics, that is the clear signal of expansion. It is the sound of factory whistles blowing, of assembly lines moving, and of a continent finally shaking off the stagnant dust of a post-pandemic hangover. The headlines are calling it the Great European Turnaround. But here at the Oversight, we don't look at the headlines. We look at the plumbing, and the plumbing is screaming that this isn't a recovery at all. It is a ghost. What we are witnessing right now across the European Union is a phenomenon known as precautionary stockpiling, and it is the financial equivalent of a terminal patient getting a sudden burst of energy right before the end. The factories aren't busy because people are buying more cars, more appliances, or more luxury goods. They are busy because they are terrified. They are hoarding parts, raw materials, and finished goods because the geopolitical map of the world is currently on fire, and the leaders of European industry have realized that if they don't buy it now, they might never see it again. This is a house of cards built on the foundation of fear, and today we are going to tear that house down to see what is actually happening behind the curtain of the Eurozone economy. To understand why this recovery is a hallucination, you have to understand the psychology of a supply chain manager in Germany or France right now. For the last several months, the Strait of Hormuz has been a geopolitical choke point that looks more like a war zone than a shipping lane. With the tension between the United States and Iran reaching a fever pitch, the oil truce that the markets were praying for is starting to look like a historic failure. When shipping lanes are threatened, the cost of moving goods doesn't just go up. The certainty of those goods arriving at all disappears. In response, European manufacturers have pivoted to a just-in-case model. This is the polar opposite of the just-in-time efficiency that built the modern world. They are ordering double, triple, and quadruple their usual requirements not because there is a consumer at the other end waiting to buy, but because they are terrified of an empty shelf. When the PMI measures output, it sees this massive surge in orders and marks it as growth. It sees the smoke from the factory chimneys and assumes the economy is healthy. But this is an artificial demand. It is a one-time sugar high. These companies are draining their cash reserves to fill warehouses with inventory that might sit there for years, and when that stockpiling ends, which it always does, the drop-off won't be a gradual decline. It will be a vertical cliff. The Eurozone is currently trapped in a circular logic that is destined to fail. Because these companies are buying so much material at once, they are actually driving up the very inflation that the European Central Bank is trying to fight. This forces interest rates to stay higher for longer, which makes it even harder for the average European citizen to afford a mortgage or a car. So, while the factories are working overtime to build products, the actual consumer, the person who is supposed to buy the product, is getting poorer by the day. We are heading toward a massive inventory glut. Imagine a scenario where a manufacturer has 1 million units of a product in a warehouse, but no one has the money to buy them because the cost of living has skyrocketed. That is the ghost recovery. It is a massive, continent-wide misallocation of capital. In the following sections, we are going to look at the specific geopolitical triggers that turned this fear into a frenzy, and why the Silicon War and the SpaceX IPO are actually the final nails in the coffin for European financial stability. This is The Oversight, and today we are looking at the death of the euro. While the internal mechanics of the Eurozone are failing, the external pressures are becoming unbearable. We have to talk about the energy reality that no politician in Brussels wants to admit. The recent surge in oil prices, crossing that 3% threshold in a single day, isn't just a fluctuation. It is a tax on every single moving part of the European economy. Because Europe is a net importer of energy, every time the rhetoric between Washington and Tehran heats up, the European manufacturer pays the price. The oil truce was supposed to be the bridge to a stable 2027. But with the recent warnings regarding Iran's power grid and the potential for a total blockade of the strait, that bridge has collapsed. This creates a secondary layer to our house of cards. Not only are these factories stockpiling goods they can't sell, but they are doing so using the most expensive energy in the history of the continent. The margins are evaporating. Even if a German firm manages to sell a piece of machinery, the cost of the electricity to forge the steel and the cost of the diesel to ship the unit has eaten all the profit. They are running just to stay in the same place, and eventually the legs are going to give out. Then we have to look at the Silicon War. The FTC's recent probe into arm holdings might seem like a distant legal matter for tech nerds. But for the Eurozone, it is a frontal assault on their technological sovereignty. Europe has long been the middle child in the war between US software and Chinese hardware. They rely on companies like ARM to provide the blueprints for the future of their industrial automation. By launching an antitrust probe now, the West is effectively putting a chokehold on the very technology Europe needs to become efficient enough to survive high energy costs. It is a pincer move. On one side, you have the Middle East making energy unaffordable, and on the other, you have regulatory warfare making technological advancements slower and more expensive. The Eurozone is being squeezed from both ends, yet the GDP numbers still show a slight uptick because of the aforementioned hoarding. It is a deceptive piece. It is the quiet before a storm that has been brewing since the early 2020s, and the clouds are finally breaking. To truly understand why the Eurozone is a house of cards, we have to look past the factory floor and look at the power lines. The recent surge in oil prices, which spiked over 3% in just a matter of hours, is not just another market fluctuation. It is a targeted tax on every single moving part of the European economy. Unlike the United States, which has the luxury of domestic shale production, or Russia, which sits on a sea of natural gas, Europe is a net importer of energy. This means that every time the rhetoric between Washington and Tehran heats up, the European manufacturer is the one who pays the immediate price. The so-called oil truce was supposed to be the bridge to a stable 2027, a period of calm that would allow the Eurozone to finally transition away from its reliance on volatile foreign fuel. But with President Trump's recent warnings regarding the glow of Iran's power grid and the looming threat of a total blockade of the Strait of Hormuz, that bridge has effectively collapsed. This creates a secondary, much more dangerous layer to our ghost recovery. Not only are these companies stockpiling goods they can't sell, but they are doing so using the most expensive energy in the history of the continent. The profit margins aren't just shrinking, they are evaporating in real time. Even if a German engineering firm manages to find a buyer for a high-end milling machine, the sheer cost of the electricity required to forge the steel and the cost of the diesel to ship that unit across the ocean has eaten every cent of profit. They are running a marathon just to stay in the same place, and eventually the legs are going to give out. Then we have to look at the front lines of the Silicon War, which has just taken a turn that should terrify every investor in the Eurozone. The Federal Trade Commission's launch of a formal antitrust probe into ARM Holdings might seem like a distant legal matter for tech enthusiasts, but for the European economy, it is a frontal assault on their technological sovereignty. For decades, Europe has played the role of the middle child in the global conflict between American software and Chinese hardware. They have relied on companies like ARM to provide the fundamental blueprints for the future of their industrial automation. If Europe is to survive high energy costs, it must become hyper-efficient through AI and advanced robotics. By launching an antitrust probe now, Western regulators are effectively putting a chokehold on the very technology Europe needs to innovate its way out of this crisis. It is a strategic pincer move. On one side, you have the Middle East and the energy markets making the now unaffordable. On the other side, you have regulatory warfare making the future more expensive and harder to reach. The Eurozone is being squeezed from both ends, yet the GDP numbers still show a slight uptick because of the precautionary hoarding we discussed earlier. It is a deceptive piece, a moment of false quiet before a storm that has been brewing since the early 2020s. This brings us to the most overlooked factor in this geopolitical puzzle, the drain of liquidity. While Europe is struggling to keep its lights on and its chips moving, the global financial center of gravity is shifting violently toward the United States, specifically toward the upcoming SpaceX IPO. You might ask what a rocket company in Texas has to do with a car manufacturer in Stuttgart. The answer is everything. We are about to witness the largest sucking sound in the history of the financial markets. As SpaceX prepares for its massive NASDAQ listing, investors are not just looking for new money to put into the stock. They are pulling old money out of traditional sectors to make room for what they see as a once-in-a-generation opportunity. Much of that old money is currently sitting in European equities. We are seeing a capital flight that is being masked by the busy work of the stockpiling factories. Analysts are already warning that this IPO could be destructive to global liquidity, and the Eurozone, with its slow growth and high energy costs, is the easiest target for investors to liquidate. As we move into the final sections of this analysis, we will see how these three forces, the energy siege, the technology blockade, and the liquidity drain, are converging to create a perfect storm that will leave the Eurozone standing in the dark, holding a warehouse full of goods that nobody can afford to buy. While European factories are frantically filling their warehouses with expensive parts, a different kind of crisis is unfolding in the global financial markets, one that is about to starve the Eurozone of the very capital it needs to survive. We need to talk about the SpaceX IPO. This isn't just another tech listing, it is a financial black hole. As of today, the news has broken that SpaceX is accelerating its timeline, targeting a historic NASDAQ listing on June 12th. The shareholders have already signed off on a 5-for-1 stock split to make the entry point more accessible for the masses. In the eyes of the global investor, this is the trade of the century. It represents the commercialization of the stars, a monopoly on global satellite internet, and the future of human transport. But for the traditional sectors of the economy, especially the struggling industrial giants of Europe, this IPO is a death knell for liquidity. Money is not infinite. To buy into a $200 billion IPO like SpaceX, major institutional investors and hedge funds don't just find new cash under their mattresses. They rebalance their portfolios. They sell what is stagnant to buy what is the future. Right now, the most stagnant, high-risk assets on their balance sheets are European manufacturing stocks and euro-denominated bonds. We are starting to see the early stages of a massive capital flight, as billions of dollars are liquidated from the DAX in Germany and the CAC 40 in France to prepare for the June 12th SpaceX debut. The Eurozone is being drained of its financial lifeblood. This is the destructive force that market analysts have been whispering about. The SpaceX IPO is effectively acting as a giant vacuum, sucking liquidity out of the old world and depositing it into the new. For a continent like Europe, which is already struggling with high interest rates and a ghost recovery, this loss of investment capital means that the house of cards has no more room for error. This leads us to the final, most devastating stage of this economic trap, the great inventory glug. Think back to those warehouses we discussed in Part 1, the ones being filled by managers terrified of the Strait of Hormuz closing. Those managers bought that inventory at peak prices using peak interest loans. They were betting that they could eventually pass those costs on to the consumer. But they missed one crucial detail. The consumer is broke. With global inflation flaring and central banks forced to keep rates high, the average person is not buying a new car or a high-end appliance. They are barely covering their energy bills. We are now approaching the moment where the stockpiling stops. When a company realizes its warehouse is full but its order book is empty, they don't just slow down, they stop everything. They stop ordering parts, they stop hiring, and eventually they start liquidating that inventory at a loss just to pay back their bank loans. This is the glug. It's the sound of the supply chain choking on its own overproduction. The very PMI numbers that looked so expansionary just a few weeks ago will invert almost overnight. This isn't a theory, it's a mathematical certainty when demand doesn't meet artificial supply. The Eurozone has spent the first half of 2026 building a mountain of goods, and in the second half, they are going to find out there is no one at the top of that mountain to buy them. The house of cards is now fully visible, but the question remains, what happens when it falls? We are not just looking at a technical correction in a stock market index. We are looking at a fundamental restructuring of the European way of life. For decades, the Eurozone has functioned on a social contract that promised stability in exchange for high taxes and slow, steady progress. That contract is being shredded by the reality of the ghost recovery. As factories begin to shutter their doors in late 2026 because they can no longer afford the energy to produce or the loans to store their unsold goods, the political fallout will be swifter than the economic one. We are already seeing the cracks. While manufacturing PMI numbers were artificially high, the services sector, the part of the economy where 80% of Europeans actually work, has plunged into a contraction not seen since the peak of the pandemic. People are no longer going out. They are no longer spending on anything but the bare essentials. The inventory glug we discussed will soon transition into a labor crisis. When the warehouses are full and the consumers are gone, the only thing left for a corporation to cut is its people. The geopolitical endgame here is one of isolation. As the United States pivots inward to focus on its space economy and its ongoing trade wars with the East, Europe is being left behind in a strategic vacuum. They are too expensive to be the world's factory and too regulated to be the world's tech hub. By the time the SpaceX IPO has finished draining the world's liquidity on June 12th, and by the time the Strait of Hormuz conflict reaches its inevitable climax, the Eurozone will find itself in a position it hasn't occupied in a century, being a bystander in its own destiny. The house of cards isn't just an economic metaphor. It's a description of a continent that forgot that real growth requires more than just clever accounting and precautionary hoarding. It requires energy security, technological freedom, and a consumer base that isn't being crushed by the weight of its own survival. So, what is the oversight here? The oversight is the belief that you can ignore the fundamental laws of supply and demand just because you found a way to manipulate the data for a few months. The oversight is the assumption that the world will wait for Europe to figure out its energy crisis while the rest of the planet moves toward the stars. The recovery you see in the news today is a ghost, a flickering image of an era that is already over. The warehouses are full, the money is leaving, and the lights are beginning to dim. As we move into the second half of 2026, the question won't be how do we grow, But how do we survive the crash? This has been a deep dive into the hidden mechanics of the global economy. If you want to stay ahead of the curve and see the moves before they make the headlines, you're in the right place. We don't just watch the news, we provide the oversight that the mainstream media ignores. Thank you for watching. Make sure to like this video if you found this breakdown valuable, and subscribe to join the community of people who refuse to be blindsided by the next global shift. This is the Oversight. We'll see you in the next one.